just jump in. Look, my name is Don Friedman. With me is Audrey Zabin.
Audrey Zabin here.
I'm an elder lawyer. She's a care manager. One of the premises of this whole program, the 5 programs where the 2 of us are going to be kind of co-teaching, is that the subject really lends itself, requires that kind of joint disciplinary participation in making major decisions.
Right.
We've always talked about that fact. We've always referred people to each other and asked each other questions. We're trying to see if we can kind of put it to a little bit of a test, trial run in an ongoing conversation tonight and through the other 5 pieces of the program, where we're going to try to really utilize that idea to try to really flesh out issues which have a very personal and human dimension, as well as legal and financial and that kind of dimension as well, but ultimately relating to the same person. So on that note, let me just jump in. Okay. There's a statement in Atul Gawande's book, Being Mortal, which has always very much impressed me, and I've used it a number of times to talk about the kind of core ideas that underlie really both of our professions in dealing with the elders. So older people have priorities beyond merely being safe and living longer. The chance to shape one's story is essential to sustaining meaning in life. Right. So he's talking about being safe and living longer. It's an interest that people have, but that's not the only interest they have. This idea of shaping one's story, of having autonomy, control, self-respect, self-determination are ideas which are strong in our culture and variably strong in most people. And people go through their lives trying to find the right balance between those things, between risk-taking, because they are who they are, and having some sense of security, protection, safety. So that's a kind of a core idea, that's a kind of a theme that's going to be underlying our discussions. We'll be looking for balances between those 2 impulses. Another idea is one of, it has so many different terminologies. Patient-centered care, physicians call it. Self-determination is something that lawyers refer to. It comes up in informed consent and all kinds of legal concepts. The idea is that the starting point in people's making decisions or are making decisions for them is that we have to have an appreciation of the individual's wishes and preferences. Start with the individual. The role of the advisor then is not to sort of create this objective for the individual, but to try to help the individual flesh it out and to try to make sure that they have enough background so that in facts and law and money issues and financial issues, so that the decision that they make is really an informed one. If we start with giving information, it doesn't work. There's, as you'll see, there's just a wealth of information out there. There are tools and strategies going in every which way. People sometimes start with a strategy, and I think that's a mistake. They really need to start with a sense of who they are and what they're looking for in their life plan in later years.
Oh, Don, one of the things I'd like to add to that is we talk about planning this evening. The reality is no one has a crystal ball that's really going to tell you how we age and what kind of care we will need down the road. However, self-determination and educating yourself and knowing what you want is very helpful in informing the planning of your care as you age. Being an informed consumer is very important. Again, no one has that crystal ball to know what you need, but only you know what you want. And if you want to direct your care, you have to really educate yourself about options out there. And certainly people who assist you in this process, elder law attorneys, care managers like myself, your financial planners, we're all able to support your plan, but you have to be the one driving the plan to determine what it is that you want. And I think that's very critical in planning, that you all have a sense of what you want first and foremost.
All right, so we've got this sort of approach where you're dealing with two different spheres of expertise and understanding and knowledge. And so where do you start? It's kind of a chicken and egg problem. I think as a matter of fact, people start in either place, and it almost doesn't matter as long as both elements are aware of the fact that the other has to be included. From my perspective, it's better to start with the care manager. The reason it's better is that then when you come to me, you have a better idea of what really you're looking for. I'll give you an example in a minute. We'll talk through these of situations where people came in with an ill-formed sense of what it was that they wanted. And leads to a lot of thrashing around as I try to help them figure out what it is. You need both kinds of information ultimately. So Audrey, I'm on the phone. Audrey, can you talk with me a minute about a couple of initial meetings I've had with clients recently? They really the meetings ran amok a little bit. They each raised questions that I wish they had first raised with you. I'd love some guidance on this. Okay, so do you have a minute? Thank you. All right. So one client came in, I'll synopsize these. One client came in, the typical is, I'm never going to a nursing home. I love my house and want to stay there for the rest of my life. This is the stay at home by choice. And the client looks at me and said, how do I pull it off? And so I'm looking at the background on the situation. I see how slowly and carefully she walked into the suite from the elevator. We talk about where she lives, and she lives in one of these huge houses on West Newton Hill. She bought it in 1948 for $50,000. She has a bank account, some IRAs, and very modest savings overall. She is house rich and cash poor. How is she managing expenses? Not so well. Where do your kids live? Far away. How many of your friends are still around? Not many. I don't go out in the winter. What's the layout of the house? It's 3 stories. There are 12 steps up to the front door. It's on and on. The bedroom and the full bath is on the 2nd floor. So, so I'm thinking, well, I can figure out strategies to sort of generate money, and we'll get to that in a minute. Somebody who actually wants to stay home and can figure out a way to do it. With her, I'm really concerned that you could end up spending a lot of money and time and energy developing a plan for her based on her wish alone that isn't going to go anywhere because it's not practical. So this is why I want her to go back to Audrey. There's a similar situation, same set of facts really, but the client is she wants to stay at home, but only because she doesn't think she has enough money to go anywhere else. She's stuck at home. She's staying at home by necessity, not by choice. We get into a lot of situations like this, and in this house rich, cash poor situation is one that's frequently encountered, and I think it seemed a good one to sort of focus on to illustrate a number of things with this program. So Audrey, what are your thoughts about this? How would you begin to deal with this with these clients?
I think it's important to say that the good news is there are a lot of options out there and a growing number of options on how to live out your life, either at home or in different communities today. So that's the good news. But the reality is, if you don't find the one that matches your level of needs for safety and support, then you're probably not going to live out a long life in that environment. So it's important as you begin to age. So for example, this elderly lady who came in who probably may have a balance issue, if Don is telling me that she's walking very slowly from the elevator to the suite, her goal may be to live at home, but maybe home is no longer going up and down 3 flights of stairs, or maybe staying at home is with modifying the house to have a chairlift. Certainly for this person's situation, we would want to do what we call a home safety evaluation. This is quite common. There are actually now specialists in the field of construction that do JCO specific, which is the guidelines for disabilities, who do nothing but JCO construction. So if you want to age in place today, you can hire someone who can assist and modify your home. If you are house rich and cash poor, Don and I will go over some kinds of programs to assist with that. But you can find someone to do a live-in today to assist with your aging at home. Certainly getting an expert's opinion, whether it's a care manager or a physical therapist into homes to help with identifying ahead of time aging safely at home, is worth looking at, because you can bring people in now who can do home safety evaluations to assist. But some people might be better off in a community, some kind of senior community. The little old lady whose adult children live on another coast, and a lot of her friends are gone now, really does not have a lot of support, or, for even a better word, engagement, much of a life in the community anymore. If her kids are gone and her friends have passed, moving to a community will add quality to your life by engaging with other people. So I think there are lots of options out there. It's really a question of getting more information to make more informed decisions. Is your home safe as you age? Do you have supports in place in where you're living now to support aging at home? And so on. Sometimes if your children your family's on the other coast, maybe it's worth thinking about moving while you're well enough and able enough to do that. So there are a variety of things we can do. It's a question of digging a little deeper to see what you want to do and what's available to you all based on your community, your finances, and your health. So those are the 3 things we do take into consideration as you begin to plan.
Audrey, one question that an issue that frequently comes up is that I understand about assisted living. I know it can be helpful for some people, but I don't need it yet. I'm going to wait till I need it. I'm independent. There's no reason for me to do that. The same thing will come up about downsizing generally, or considering moving closer to kids. I don't need it now. I'm fine. I want to keep things as they are. I'm worked up some kind of strategies for dealing with clients, but how do you deal with it? It seems to me that timing is it's important for people to think about.
Timing is critical.
When it can really adjust to the new setting.
Yeah.
How do you
Timing is really critical. And I respect someone's wishes, whatever they want to do, but I can tell you that if you want to be making your own decisions and you want to be in control of where you're going and not wait for a crisis, then you're better off making these decisions earlier when you're healthy and well to do them. If you wait for a crisis to occur, which is often what will happen if you don't plan ahead of time, we know there will be something that will come up. You don't often have the control you want to be where you want to age. The places may not be available, or you may not be able to travel, and so on. So it's really a question if you want to be in control and make these decisions, or wait for them to happen when you may not have that element of control. I mean, the reality in all of this is, all of us, we know this. I mean, whether we're 56 or 86, right? It is easier to move when you're younger and do all these things when you're younger than when you're older. It's just the reality of it all. So why you would wait to make these decisions and make it harder on yourself is certainly up to you, but it does make things more difficult.
All right. Now, so my client wants to stay in the house, and even to the extent of doing hospice at the end. That's really her commitment. So I guess the next issue that I wanted to talk about was this question of so what does she do? Are there any strategies that she can use where she really doesn't have enough money to pull things off herself? So maybe let me talk about that. Here, three general points, and then I'll get into specifics. For first thing I should say outright, I'm not a financial planner. These are strategies and tactics that I've worked out with planners, and planners have taught me, and that we've used in the office with clients. So, but I think the approaches are valid and at least illustrative of things that you can do. The general ideas are really some before the do's, some don'ts. One thing is to keep it simple. Airwaves are flooded with investment and make money schemes and simple ways to get onto Medicaid. If you don't understand it, don't do it. So keep it simple, keep it flexible. Whatever you do now has to be done, given these complex and uncertain times particularly, has to be done in a way that leaves you options in the future, to allow for changes in circumstance. Have a fallback plan. The third is don't get cute. We've seen so many illustrations of this where people have tried to really take maximum advantage, undue advantage of special exceptions in the law, and they get caught in it. My example, not that this is a real example, but I said, don't donate your backyard to the city as a nature reserve with the idea of getting a deduction, and saving your yard care expenses. That's kind of extreme cuteness, but actually we've got leaders who have done this. So I guess it's not a terrible example, but avoid being cute, right? So specifically, then what do? You first start with the kind of getting an inventory on what you have: house, retirement assets, liquid assets, long-term care insurance if you have it. Then let's look at each of these things. In the house, in our case, the client has value, but nothing that she can translate directly into anything that she can use for paying her bills or for renovations that she might need to really make the house accessible to her and usable over the long term. One of the approaches to explore just involves the borrowing, and using the house as collateral, this mortgage loan approach. The problem which will occur to her immediately or as soon as she applies is that eligibility is based largely on income, and our individual has Social Security. She's counting as some of her income, her withdrawals from retirement accounts, but that's an asset. It's not giving her, it's taking away from her assets. She's drawing down her savings basically. So she may feel that she's stuck, but there are options. One thing to consider among the options is the first mortgage, if she has no financing at all, refinancing if she has a mortgage to generate more money, if she needs a kind of a lump sum to do large scale work, a renovation or something like that. A home equity line of credit, similar to a mortgage, has the same kind of impact, but with the flexibility of drawing just as much as you need. So somebody who has a shortfall in monthly expenses would probably favor that kind of approach rather than a mortgage where she's going to be paying for all of this money that she's added to her bank account and not using. But so what do we do with this issue of the eligibility given her low income? There are two things to suggest. One is that small banks, local banks, are much better at dealing with kind of special situations than large banks. Large banks don't keep their mortgages, they sell their mortgages, and to sell their mortgages, they have to meet certain criteria. And those involve kind of strict criteria relating to level of income, things like the relationship of the individual to the bank, their length of time in town, their community links, the overall value of the house in relation to the size of the loan. These all take secondary importance. With a small bank, particularly if you have or are willing to put your savings there, use them as your regular savings bank, can be very effective and flexible in dealing with loan situations. It's like Village Bank versus Bank of America. If you want to think about the extremes of your options locally here. Second thing has to do with co-signing or guaranteeing. Now, banks are interested in making sure that they have security on getting their money back. If someone else is co-signing or signing as a guarantor on a loan, then they really are protected, particularly if the amount of the loan is relatively small in relation to the equity value of the house. Now, if one of your kids is in a position to guarantee payment on the loan on a house, then that can be a very effective tool. If the kid is one of the people who's going to inherit the house in the end, in any event, it's very little risk to that child to do the loan, particularly if the math works out, if their income, elder's income, in conjunction with the other things we're going to be talking about, is enough to keep things solvent. Another approach, also using a family member, is not to look to a bank at all to make this loan, but look to a family member. This could be a sibling as well as a child. This is a secured loan when it's paying interest, so it's really for the person making the loan. It's an alternative investment that might actually pay better than having the same amount of money in bank accounts. Let's give an example of, there was a case that we had where this really worked out. Widowed parent had 3 kids, a teacher, a social worker, and an orthopedic surgeon. Right, so 2 of them are very, cash limited themselves. One had significant resources. Your position as the parent is that you love them equally and they're going to factor equally in your estate plan. And with regard to asking a child for help, it's something that you just are, is anathema for you. You don't want to do that. You would rather, die than ask for help. So you're kind of stuck in this situation. You're also, you're not sure what impact, you don't really know how much money the orthopedic surgeon daughter has, and you really don't know what impact your taking money from her might have on her own ability to meet her kids' needs. But the idea of a loan is a business proposition, and it may really work. If a loan doesn't affect the balance sheet of the person who's making the loan, they don't have that cash anymore at the moment, but they have a debt that is worth that amount of money and more, secured by a house which is worth much more in value. The way the loan would work is that it would be paid off at the individual's death when presumably the house is sold. Then the person making the loan would be repaid just like the bank would be repaid on the mortgage, and the balance would be split equally among the 3 kids. So the overall plan of equal treatment of the kids it remains in place. It really can be a very effective way of doing it, particularly if there's difficulty with bank financing. since the family is going to end up with a house in any event, it's much less risky for the family than it is for the bank in making a loan like this. So let me talk about kind of the general investment assets. Let's say she's got $200,000 or $300,000 in general investment funds with Fidelity. One thing to think about is the investment allocation, stocks, bonds, and cash, and the array of specific investments. When this was set up, it may have been set up for the long haul with a lot of emphasis on growth and inflation protection. Very different posture now late in life where you're looking for income. And so you may want to just kind of recast the investment policy in a way that's more productive of income, to maximize income rather than growth. The retirement accounts. Here, one reason sometimes people feel cash strapped is because they have a lot of assets in retirement accounts and they don't want to take them out. The idea, they realize that when they take them out, it's going to be taxed. And if it's taxed, they're going to have to pay money on it. So that they don't want to do that. They wouldn't take money out to help finance a renovation, for instance. And if they don't have enough money in cash to do it, then they just forego it. They have to take out their minimum required distribution if they're 70 or older, but they don't want to do more than that. Now, about this, I think that really you have to help them rethink this whole situation a little bit. I mean, first, retirement accounts don't avoid tax, they just defer it. It's going to be paid by somebody sometime. In fact, if you are retired, taking out your minimum required distribution, have no other income, then you're going to be paying taxes at a very low bracket. If you hang on to that for your life and then your kids get it as an inherited IRA, they're going to have to start drawing immediately. Inherited IRAs are different from retirement IRAs. They'll have to start drawing immediately. And that money is going to be taxed at their rate on top of that orthopedic surgeon's salary. So it's going to be taxed at phenomenally high rates. The second thing, and so that should encourage them to try to use this more during their lifetime. It's really more advantageous for their kids than it is to, inherit these things. Let them inherit something else like the house, beefed up with the renovations that have been done. Second thing that they really don't understand is that the way the tax structure is set up, the tax rates are in brackets. If you're getting minimum required distribution in a 22% bracket, then that's your starting point. That's a broad bracket. For an individual, runs from taxable income of 40 to 85,000 for an individual, 80 to 171 for a couple. So if you get the MRD, and let's say that puts you in your taxable income, your accountant tells you is $42,000, just above the minimum, you can take out actually another $40,000 as an individual from your IRAs without paying any higher tax rate. It's going to be taxed at the 22%. That's the best you're ever going to be able to do. It'll never be taxed at a lower rate. So there's really no disadvantage. If you took out more than that, it might bump it up a bracket, and that's then becomes more of an issue. But people very often have a good spread of available space within their bracket to take retirement accounts out and use them effectively. I mean, this is something that can be done to people at any age. So let me also talk about the house, other things that can be done with the house. These are sort of bigger things. One is a rehab loan. The City of Newton has a terrific zero interest rehabilitation loan program. I don't know how much money it has available right now, but it's an open program, and there are some income limitations on eligibility, but they're high. They're certainly way above anything that we're talking about tonight. Almost anybody who's retired is going to come into those areas, and it can be a terrifically powerful tool. And again, it's zero interest. It has to be repaid when the house is sold or when you die. But so what? You've accomplished, done a lot.
Don, I have used that with great success, and I've used that for things like even stair lift rentals.
Yeah, right. It can be
even
done
for just renting. Yeah,
right.
the stair lift.
For both. Second powerful tool is real estate tax deferral. This is something that people just don't utilize very much. but this is another city, it's a program statewide, it varies a little bit from city to city. But the idea is that if you're over a certain age, and that's our range, then you can have the city defer your taxes. It means that you don't pay any real estate taxes. That on this house on West Newton Hill at $18,000 or $20,000 a year is just, you've got $20,000 more of income by not having to pay that tax. The interest rate used to be high on these deferrals, and it was a disincentive for people, but the current rate, I understand, is only 3%. So it means that ultimately it's going to have to be repaid with that interest. And if, when you sell the house in 5 years, it gets repaid. Still, it gives you, without making more money, you have more money by limiting your debt. A couple of other dramatic things that I think can be really interesting and entitled in this whole issue of your kids and your kids' situation, and Newton being so expensive to live in, and your kids can't live here, and you've got a daughter who's got, divorced, she's got 2 kids, she's living, somewhere in northwest corner of the state because that's the only place she can afford. There may be some things that you can think about doing that could really solve a number of problems. One is now in just 3 years ago, between 17 and 18, the state, the city of Newton implemented a new accessory apartment program. Accessory apartments defined in many ways in many areas. In here, it's a portion of a house. It can be an interior set-aside portion. It can be an add-on portion on the side. It can be a converted carriage house. Looking up those houses up at the top of the hill, where you can, some by right, some requiring a special permit, but you can build one of these things into your house. Accessory apartment there are size issues with it, can't be very large. And there are requirements that it be kind of self-sustaining. It has to have bathroom, it has to have some kind of a kitchen situation. It's like a small apartment, it has to function that way, but it can be part of your house. There are lots of ways that an older could use that given different situations. One is that they can rent it. One is that they can live in the apartment and rent the big house to the orthopedic surgeon's buddy who's coming here for 2 years of residency. It can be very effective. It can be used by family members. It could be set up as basically a 2-family situation where you and your kid and your grandchildren, whom you love intimately, but not 24/7, you just can't envision that really working out. This gives you some space within the context of a framework where there can be mutual assistance and aid and babysitting and help with the parent as he ages, but still have some separation, so there's some feasibility. I think it can be a very powerful tool. And if you weave together the financial things and the loans and so forth, rehab loan, it's something that can be really pulled off. There is making your house into condos. We've seen this, there are many areas in Newton are already zoned as multifamily zones. You don't really are aware of it. There's one right across the street from Temple Emmanuel. The one side of Ward Street is 2-family, one is 1. And there are, as you go down those streets, you'll often see, typically a side-by-side dual property. It's most typical summer over/under. But this is something in multifamily zones that you can do with a large house. There are some that have been done in that area that are 3 and 4, 5 units within the context of a large enough house. If you want to stay and live independently and live in one of those, condo it that way, live in 1 unit, have 1 unit for your kids and sell the other 2, and you're golden for your lifetime. The zoning issue is something you also want to watch for. Newton is starting a program of exploring a number of zoning options for a new zoning law. They're going to start public hearings next year. One of the proposals has to do with eliminating single-family zones in Newton so that the whole city would be open to this sort of development. And the problem we're talking about is one of the key underlying goads to that working in that direction. I think I'm going to be talking about some of these things too much. All right, so we've kind of exhausted what they've got in the bank, kind of exhausted looking at the house as a source of potential support. Let's talk about some of the benefits of the resources that people have. This is something we'll definitely put a lot of material in on the handouts. There's one actually I think was emailed to everybody tonight as a kind of an overview of benefits. We'll be putting out a lot more on these as we go. So I'll go through some of them just rapidly, spend a little more time on Medicaid because I think that's probably of interest to a lot of people. But there are a whole set of things under Social Security, the Social Security Act. The key ones for in this context are Social Security retirement for people over, 65, 66, 67, depending on when they started taking benefits or will start taking benefits. If people had been on disability benefits earlier with Social Security, it transitions automatically to retirement benefits. It's a terrifically useful program. One of the key issues, though, that bears highlighting is that there are the issues of the timing of your application, particularly if you're married, get very, very complicated and really takes some care. Social Security, I think, has gotten better at kind of running scenarios for you, but it's really a problem. Just one aspect of it on timing has to do with the fact that while you can begin taking retirement benefits at age 62, and you can actually defer benefits past your retirement age all the way to age 70, the benefit range impacted by that is really huge. If you retire at age 62, your benefits may be as much as 30% lower than they would be than if you retired at your ordinary retirement age. On the other hand, if you wait until age 70, your benefits will be 8% per year larger in perpetuity for every year that you wait beyond your normal retirement age. So we're really talking about a swing of almost 60% in your benefit level, depending on the timing of your application alone. And I think that people, it can be so important that people may feel that they want to make other plans to make up for lost income from retirement as a way of gaining this edge. But in any event, you need the numbers in front of you when you make that plan. Social Security disability is also an important plan for many of the people we deal with. We're speaking about older people, but there are the whole class of people who have the same kinds of benefits and situations. These are adults which haven't reached the old age threshold, which is really 65 for a lot of our laws. But because of Parkinson's or MS or brain, traumatic injury, or younger onset Alzheimer's disease, aren't elders, but are dealing with these similar situations. And for them, the Social Security Disability Insurance Program is tremendously important. Supplemental Security Income is another Social Security program for people who are elderly or disabled or blind. It's also for people who are low income, but an advantage of it is that you don't need to have worked to become eligible for it. There's some special programs, particularly relating to assisted living, that can be particularly important in using SSI. Social Security survivors benefits. This is one that a lot of people miss, and there are just so many different options of it, and so many people are eligible for it. The sort of the easy case is if we have a parent who becomes disabled and has minor children, the children are eligible for benefits. The widows are eligible for benefits. Workers, adult children who are disabled prior to 22 are eligible for benefits. The individual's parents can be eligible for benefits if the individual who's dying has provided them with significant support. So it's the kind of thing that you really have to explore with Social Security. The website is, their website is pretty good with material. We'll be putting out pieces on this specifically, but I think a lot of these programs get underutilized. I had a call from a client yesterday who said, she was divorced and her ex-spouse died. And she had been getting just Social Security from age 62 on her own work record. And she said, it just dawned on me that, I heard he died. I haven't seen him in years. Is this meaningful for me? I said, well, yes. I mean, it should be. I mean, because of this, the death of a divorced spouse is a basis for making a claim on his record. She called Social Security. It took about 4 minutes, and they said, no, we're going to send you a net. There were some adjustments in it, but she picked up an additional $1,000 of benefits in making that claim that she had, just on a fling, thought she might be eligible for. So keep asking, keep looking. If you're involved in any kind of survivorship or disabled person, or if you're caring for kids and your husband's disabled, any of that stuff, really explore it. Right now, I want to spend a few minutes on Medicare. And two big aspects of this program. One is that, it's for people age 65. Critical factor there is that it's not directly tied to retirement benefits. It's not, you can forego retirement benefits until you're 70, but you can still apply for Medicare at age 65. On the other hand, if you apply for Social Security retirement at age 62, you still can't go on to Medicare until age 65. So it's really important. The other major complicating factor with Medicare has to do with Part B. Right? So these are outlined in the stuff we'll be sending out, but there are all these parts to Medicare. There's A, B, C, and D. The A is sort of the basic coverage for hospitalization mostly. And it doesn't cost you anything. If you're eligible for Social Security, you're eligible for that for free. I mean, if you're eligible for Medicare. B is optional with a sort of a tag on. I mean, it's optional and you don't have to take it, but if you don't take it, you're going to be facing very substantial expenses in terms of deductibles, co-pays, and all of that. So almost everybody takes B as well. And then they also take then MedX, which sort of fills in some of the residual gaps from those two programs. Right. Now MedX is also not is voluntary. You don't have to do that at all. Now sometimes when people are on Medicare A and they're interested in B, but they find that their spouse is still working and they're covered by their spouse's insurance, and their spouse says, I don't think you have to go on B now. As long as I'm covered, then you don't have to start on B now. If you start on B late, there's a penalty, and the penalty builds in forever a higher level of premiums for you on B. So you don't want to fall into that situation. If you decide you do want B, you want to be very careful about not taking it when you're first eligible. And there's some real pitfalls here, and people have followed up on this. There's some kinds of employment insurance are fine, give you the good excuse for not starting on B. Some insurance doesn't give you that excuse. One is insurance under a COBRA program. You're covered under your husband's employment policy, but it's on COBRA. He's left his employment, and this is in the 12 or 18 months afterwards. COBRA doesn't count as an excusable reason not to start short. So if you wait, two things happen. One is that you can only then start in this very limited annual enrollment period. Then you have to wait for January 1st. So you may be without insurance at all for almost a year, depending on how your timing is. And the second is you're going to have this penalty. So just if you are delaying the Medicare Part B, make sure that you've talked to HR, maybe talk to Social Security, make sure that your excuse is one that falls within their exceptions. Let me see what else I need to talk. Oh, Part C, Medicare Advantage, is another area I think of great confusion. I'm just going to try to highlight a few things that I think are causing people concern or confusion. In this Part C is called the Medicare Advantage programs. This is, well, it's in the Social Security Act. It's kind of an alternative universe of coverage. What Medicare will do is agree to pay an insurance company a flat amount for people who enroll in these private insurance programs. And that amount is supposed to, cover the services that the individual needs and wants. The person really isn't on Medicare at all anymore. They're not on what's called original or traditional Medicare. They're on this separate private insurance, which has all of its own rules and claiming procedures, appeal procedures, all of that stuff is to the side. And the problem is that people think it's just a sort of a cheaper way of getting their A and B, because sometimes the companies they'll say it won't cost you anything, or it'll cost you less than the Part B premium, and people view it as a bargain. And the problem is that people don't look carefully at the program and really aren't aware of some of the limitations in it.
Don, in fact, if I could just add to this, certainly you've seen the Part C advertised on TV where they're going to offer you free eyeglasses or free hearing aids or free gym membership or whatever it is. But the reality is it actually lessens your options for care. For example, they have contracts with certain rehabs, but maybe you don't want to go to one of the rehabs they have a contract with. Maybe you want to go to another rehab. But if you opt for C, you have limited options. You can only go see their doctors. You can only go to their rehabs. And as a care manager, I would advise you, as you age, you want to open up your options for care, not limit them. You want to be able to go to any rehab if you want to. You want to go see any specialist if you want to. And C does not do that for you. So I just wanted to reiterate.
Yeah, even getting to a specialist at all. Most of the programs are referral is required from the primary care physician in the program, to go to a specialist. So even that door itself, let alone the choice. Medicare is, you're open to any hospital, any provider, anywhere who participates in Medicare. That's the only limitation on it. So it's a very different program. All right, so let me, I think that Part D.
And there's Part D.
Right, Part D, again, it's called a Medicare program, but it's administered directly by insurance companies who are paid primarily by the federal government, and then to a lesser extent on a subsidized basis by the people who are participating in it. This has gotten very complicated. There are many insurance. Last year when I was reviewing this for a client, there were 36 or 38 companies doing business in Massachusetts and selling prescription drug policies. Making the choice is very difficult. There's a lot of apples and oranges in the comparison. Some will have lower premiums, but higher deductibles and copays, and different sets of requirements on what you have to pay for different drugs at different tier levels, and drugs will be in different tier levels in different programs, and you'll go crazy. There is on the Medicare.org website, there is a good program that the government runs. It's not tied into any of the private companies. As an aid in selection of companies. You put in information, you can actually put in your drugs and dosages, and it'll give you some comparison information about the programs that you might want to look at.
Right. And I think the Massachusetts Office of Elder Affairs also has a similar worksheet whereby you plug in your medications and they spit out which programs, which insurance companies are probably the most cost effective.
The Newton Senior Center also has a program involving
Shine.
The Shine program. There are volunteers in the community who are trained to do this stuff, and they're all good resources.
And I think the other thing just to add is, so there are open enrollment windows throughout the year.
In right now.
Right,
And they're
that's right.
short. Yeah, and this administration made them much shorter for, I guess, obvious reasons to keep people locked. All right, so the period is October 15th to December 7th. Used to be to the end, used to be October 1st to the end of the year. But it's October 15th, so we're in it now. And this is the time for people to revisit, you or your parents, whoever we're concerned about, to revisit. Don't assume that you're in the best deal. You received a booklet from your company, which was probably, if I can see this, about that thick, can't get it in the camera, this thick of changes in your plan this year. Nobody, except lawyers, read those things. And it's impossible to make sense and then compare it to everything else. It's really, so people you said, throw it in the recycling and that's the end of it. But it's maybe very important, particularly if your medical condition has changed or your medications have changed, that you should look for a better deal. All of these things we've talked about relating to money, things and saving can really accumulate. And it's not that any one of them is going to make this house rich person, flush with cash, but they all help a lot. All right, we've got about 15 minutes. I think I'll start with the Medicaid stuff now, you think?
Do Medicaid.
Okay.
Yeah, the Medicaid planning.
All right, here I actually wanted to go back to mention I had a kind of a third client, kind of a typical client situation that I wanted to broach, and this is the more problematical one. This is, what did I call it? I called this person the Medicaid planner. The Medicaid planner. This is somebody who listens a lot to talk radio, and they take a lot of notes, and they come in with fixed ideas of what they want. And their question really is, I've had clients, how much does a deed cost? Well, not much. I mean, there's not much involved in drawing up a deed. We'd want to do a title check to make sure there are no problems with it. And we need you to understand the tax ramifications of what you want to do. But the deed itself is a simple instrument. But you have to go. This is the danger of using the sort of the web to do your legal planning. You can go on the web and say, draw me up a deed, and some program will draw you up a deed. You have no clue as to what it is you're actually getting into legally. So I have to back them up to say, well, what do you want? What are you planning to do? You selling your house? No, I'm giving it to my kids, or I'm transferring it to an irrevocable trust. And then you have to get into the conversation in kind of a back way. Let's, think, have you thought really about the ramifications of that? No, I trust my kids, and if I need it, they'll give it back to me. And I said, well, it doesn't necessarily work that way. You really need to think about this. Somebody talking on the radio is not really developing these ideas with you, so you really need to back that up. And this Medicaid issue is one area where these things come up, these sort of magic strategies, annuities and irrevocable trusts that are viewed as cure-alls that are really enormously problematical and can lead to you tying up assets in a way which really take away future options for you and expose you to all kinds of risks. So let me then flash forward to some specifically Medicaid, a little Medicaid discussion. One second. Right, so Medicaid, Mass Health, same thing. Mass Health is just the local name. In California, they call it Medi-Cal. It's all the same. It's a state version of a federal program. It's important to recognize, though, that these are federal state programs, they're called. It's kind of joint program. They're jointly funded by the states and the federal government. And the states, to get the federal share, are obligated to meet certain criteria. But states have a lot of options and can negotiate a lot as to what they're going to do.
And Don, you make a very good point, because I'm sorry to interrupt you, but everyone needs to realize that states are different. So if you have an elder in another state, their Medicaid benefits could be very different from what we know here in Massachusetts, and vice versa. So if you are You have to be in the same state to be able to plan accordingly for that.
You're thinking of moving, recognize that it's not transportable. The service system is not
Right.
transportable, but neither is the structure. Massachusetts is
Right.
really very, very generous in relation to many states in these programs. That's a critical point. Waivers also, the federal government is allowing states in order to, experiment and try new things and be more efficient and whatever, allows for waivers. So the program itself is very hard to pin down. It has a multitude of parts dealing with a multitude of issues. It has to do with people beyond elders, people who are just poor, people who are disabled, in all kinds of circumstances. It goes beyond medical services. It covers different kinds of non-medical rehab, alternative residential care. One of the group adult foster care program in Medicaid is involved with funding of assisted living. The PACE program, which I'll mention in a minute, is another special Medicaid program that gets involved with assisted living. So it's a very, don't assume it's just medical. The benefits from it may be particular to you, but you need to explore those as you're thinking about whether it's worth applying or you should apply. It may have less to do with medical issues than non-medical. And there are also a number of very special programs for people who are eligible for both Medicare and Mass Health. This is a kind of a rich pool here. It's a program involving the federal government pooling Medicare funding with the state pooling Mass Health funding into a much more comprehensive kind of a package.
Benefit.
You're also typically, there's limited choice, but very comprehensive services, including quite extensive services for people at home and other settings. So there's a lot to explore with the care manager. These are one of the ways, once you get a handle on sort of what it is you need, this is the kind of array of programs that we look for.
Don, I just want to let you know, we're getting a number of questions in the chat room that you might want to look at. And I know that we have, Tracy wanted to say a few words as well.
Okay.
Coming on 7:30. So.
All right, actually, this is an important question. Is the session being recorded? I understand it is. Am I correct?
Yes.
Is it good? Okay, good. Yeah, the comment about Shine.
Can you please elaborate a bit?
On
irrevocable trusts.
Oh, good. Okay, good. All right, so let me talk about that.
That'd be good.
All right, so I'm going to be, one of the papers I'm going to be doing is going to be on trusts. It's going to list, there are, at last count, we had about, in the office, we had like 15 kinds of trusts that we used for specific purposes, relating to taxes. A lot of them had to do with people who were older or people with disabilities. And an irrevocable trust is one of those that's gotten a lot of play. It is one we used to use in the Medicaid planning context quite a bit. We're not using it now. But what it means, first, a trust. What is a trust? A trust is just, it's really a legal arrangement for holding some asset. The arrangement involves an asset and an agreement. The agreement says that by a trustee saying, I agree to hold and manage and use these assets in the way I'm instructed in this instrument for the benefit of the people who are identified in the instrument as beneficiaries. So it's kind of a three-part agreement. One person's holding stuff subject to rule, not his own judgment, but subject to rules in the instrument for the benefit of a second party, for somebody else. A trust can be revocable, the most common kind. Revocable means call back, cancel, amend. It means that the trust provides a kind of structure for holding stuff, but it's something you can change altogether. You can change the trustees, you can cancel it, you can pull all your money out. It's used to avoid probate, and it's used for some other specialized purposes, but doesn't have any tax or Medicaid advantage. An irrevocable trust. And it's unfortunate that the terms are so close, because when you talk fast, you miss the the distinction. Irrevocable, IRREV, means the trust, once you put money in and once you sign it, the trust itself can't be changed. The terms are frozen, who the trustees are frozen, and you can't get the money back. It's in there. It can be used only in the ways that are spelled out. If you later decide that it was a bad idea and you could have used the money for something else, you can't get it back. If you later decide that you don't like this trustee, you can't get it back. You can't change the trustee. There were some theories, and still I'm seeing that some lawyers doing this work are still using them, that putting money into an irrevocable trust could be helpful in the Medicaid eligibility context. Putting the money in triggers a 5-year, potentially plus, disqualification period for eligibility, but people were doing it when they felt young enough and that they felt they could risk that. They also felt that being eligible for Medicaid 5 years in the future was actually going to be helpful for them. And that's another big issue. It may not be. Medicaid might be here in 5 years, and what they need may not be funded by Medicaid at all or at a level of quality they want. But in any event, there's that 5-year window to figure out what happens if something bad happens in the meantime, what's going to happen. The other aspect of it is that the individual, the beneficiary, could retain the right to receive the income from the trust, but they had to absolutely give up the right to ever receive any benefit from the principal, from the money that they put in initially. So if the $100,000 goes into this trust, or $1 million house goes into this trust, if the house isn't earning any income, they get nothing out of it. If it's $100,000 in the bank, they're getting 20 cents a month out of it. That's the benefit they can get, is just the income. The only people really potentially benefiting from this are the ultimate beneficiaries, who are going to be the family members. They're going to get it at the parent's death. And there was a time when if people had a lot of money and wanted to use an irrevocable trust for a very small portion of that, but were retaining enough to cover any of their own future needs, then at least you can make an arguable case for this being potentially useful. But it's highly suspect, and you really want to, if somebody's proposing it or you're raising the question, you really want to play the skeptic about it and really get a convincing case. We're really nervous about anything that's irrevocable in planning today. There's just too much in the air. None of the things I think we mentioned before are irrevocable. The financing arrangements and applications and loans are all things you can get out of if you need to. None of it's permanent.
Don, there's been a lot of talk about reverse mortgages.
Yep.
I know that's a question that I get a lot.
Yep.
Wonder if you could speak to that.
Yep. All right. The idea of a reverse mortgage is that whereas with a mortgage, bank gives you a chunk of money in exchange for the security on the house. With a reverse mortgage, the security is still there, but the bank kind of doles the money out to you on a planned schedule. They give it to you as if it were an annuity payment or something. Some plans, those payments can be flexible, they can be larger or smaller, but their distributions are sort of an advance on the instead of the big loan, you're taking it out in pieces. It kind of works a little bit like a home equity loan. There are several problems with them. One is that they typically are time limited. The idea is that at the end of the loan, the bank's going to want to be repaid whatever it is that you've taken out, and your agreement is going to be that if you can't do it, then the house is going to be sold, and that's the only way the bank has of getting its money back. So they're not open-ended. Another problem is that they're very expensive. They're expensive to set up. There are lots of fees involved, and the interest rates, the way they may sound small, but the way they work it and the way they compound it, really you end up spending a lot of money on interest. It's actually so suspect that the government requires before you can take one out, that you go through a formal counseling program. This is highly structured, and it's not by the loan people themselves, just to make sure that you understand the ramifications of it. We've, reverse mortgages have probably been around for 25 or 30 years, something like that. Maybe a little less than that. We've been aware of them as a potential planning tool for elders over that time. We have probably counseled, not in that formal sense, but talked to clients about evaluating these things in maybe 5 cases over that period of time. In no case has a client actually pulled the trigger on one of these arrangements. I really don't know how highly utilized they are. There's very little published on how effective they are or people having problems with them. I haven't web researched it recently, but they're much less flexible, forgiving kind of an approach than some of the other things we've talked about. A home equity line, home equity, even if you take money out of it, with many of the programs, it's their interest only on payments. So even though you may have to repay something, it's a small amount. They're renewable in 5 years. You can refinance with them. You can convert them to a mortgage. It's just much, much more flexibility in terms of what you can do with them.
We have a question. Is the 5-year look back only applicable to irrevocable trusts?
No, it really is. It's generally applicable, everything with specific exceptions that deal with very particular circumstances. One important exception is to transfers between spouses aren't subject to the look back. So if the house is in mom's name, she could transfer it to dad. That's not a problem. If you have a disabled child, you can transfer assets to the child or to a trust for the child. With the house, if you're sharing ownership with a house with a sibling, there are arrangements for transfer of interest to the sibling. If you have a child who's living in your house and providing care for you that's keeping you out of a nursing home, with some technical criteria, a transfer to that child is permitted, obviously in the interest of the state and keeping people out of nursing homes and wanting to provide an incentive. This could be that provision in conjunction with the either the condoing with the family member or with the accessory apartment. It could be a very powerful tool.
That's right.
For an overall estate planning as well as in meeting immediate family needs.
Don, what about special needs trusts?
Yep. All right. So the special needs trusts is one kind of trust to which a transfer is permitted. When I talked about transfers by a parent to a trust for a disabled child, that's one of the special elements in that kind of array of possibilities. What's called, in the terminology, it's got confusing. For years, the term special needs trust was kind of a generic designation for any kind of a trust that was used for a beneficiary who had special needs, typically the son or daughter of the client who had Downs or other special problems or was on disability. The federal government in '93 sort of co-opted the term, created a capital letters special needs trust, and defined it in a very narrow way to cover 2 specific circumstances. So as you'll see when I send out the trust stuff, we've changed our terminology. We call special needs trust is a special federally approved thing. A supplemental needs trust is this general trust that parents might use in their estate plan where they're going to leave some money for a disabled kid. The special needs trust, and for 2 situations, one where the individual himself, this is for the this disabled individual, receives money, inherits money from an uncle, unexpectedly and unbeknownst to anybody. He's on SSI, and it's gonna push him way over the $2,000 level. He won't be able to keep his SSI. What it would mean is that the inherited money would just have to be spent down until it disappears, then go on to SSI again. With a special needs trust provision, the law would allow that individual to establish a trust meeting certain criteria, transfer the inheritance to that trust. The transfer will not cause a disqualification. The money in the trust will not cause a disqualification, won't be counted as an asset. And it can be used for him over his lifetime to provide things that he can't get from his own or from other services. The only little bit of a quid pro quo in it is that at his death, at the beneficiary's death, to the extent that the money hasn't been used up, the state has a right to be reimbursed just for Medicaid services that were provided, not for the SSI itself or other things. So it's a great, what it does is makes the trust primarily and first available to the person for his lifetime needs. Only if it turns out that he doesn't need it does this kind of clawback provision, it's called, come into play. Many times with families, we end up with two trusts. We have the special needs trust dealing with that issue, and we have the family trust in the parent's estate plan. So the individual could be eligible for both. In those cases, we just use the special needs trust first. That's the one that's subject to the payback. Use that one up, then use the family trust. So the significance of the clawback disappears. There's one other circumstance that I should mention. It's going to come up as a focus in a later program where we're talking about aging parents of people with disabilities. And that has to do with the parent who has a disabled child and where the parent needs to apply for Medicaid, particularly for nursing home placement. So here we have a parent who has a house and $100,000, and she has the disabled kid, and that's the only person that she needs money for in the world. And she's going into a nursing home and is deathly afraid that all of that resources for the child is going to disappear. It's going to go down the tubes, just depending on the good luck or the bad luck of how long she lives. What the law will allow her to do is to transfer the house, could transfer the whole house to the special needs trust for the child. No penalty, no clawback for the parent. The parent it goes beyond, there's no estate recovery issues. The parent in the house are just out of the picture with regard to the parent's nursing home placement. The parent may decide that she wants to hang on to the 100,000 or some of it, spend it down, get well established in the nursing home, maybe use some in a pooled trust account. That's something else, another tool that can be used in this array. We're talking about more of that also in a later program for her own benefits. But she can use the special needs trust in that way as well. So it can be a very powerful tool if people are aware of it.
There are a couple more. Are trusts honored if you move to a different state than where it was drawn?
All right, that's okay. Well, there are two aspects of that answer. One, the general law in the United States. There's a provision in the Constitution called full faith and credit, and it has to do with differences in state rules. Doesn't really go as far as you'd want it to go in this case. But with regard to the trust itself, the basic law is that if a trust is valid in the state in which it's executed, so the witnessing requirements are there, the trustee is appropriate, all of what made it valid in that state, it's properly witnessed, notarized, all of that. If it's valid in Massachusetts, then it will be valid everywhere. On the other hand, how states, in the context of a particular benefit program, treats trusts is variable. And we don't know, in this, we've had issues with trusts in Pennsylvania, or a situation where a family was moving from Massachusetts to Pennsylvania or going to think of it. And the issue had to do with how the trust, which worked fine in Massachusetts, how it would work in Pennsylvania. And it's a question that's
answer.
Can't be given a blanket guarantee. It's something that requires, if there is going to be a move, it requires the asking of the question. Just like with the whole estate plan, our plan was fine in Massachusetts. Is it going to work in Pennsylvania, given estate taxes here, and also given these benefits issues? Or is there something that we should do differently? If we know in advance in drawing up the trust that the family is planning to move to Pennsylvania in 2 years, then we can draw the trust up in a way that will comply with both. What we would do is confer with a similarly experienced lawyer in Pennsylvania and explain what the situation is. What I would say is that, look, I'm going to show you what we would do for Massachusetts. Look at it. Tell me whether there are any tweaks that would be necessary to make it work in Pennsylvania as well. But obviously, we can only do that if we sort of know in advance what the plan is.
The last question is, if you transfer house to a child who's caring for you, would he lose the step-up value that he would get upon the death of the parents?
Well, all right. So there are several ways that you can do this transfer. One, if the transfer were just outright, absolute full ownership to the child, then you would lose the step up. What the step up means is that ordinarily when you sell a house, you have to pay a tax on the profit that you made. Profit is the difference between what you bought it for, plus expenses, renovations you put into it, and what you got on the sale price. That's the capital gain, and that's what's taxed. The rule on step up and basis is that if a person dies owning the house, and then the house is inherited by a family member or sold by the estate, instead of using the original cost as the floor to measure profit, you use the fair market value at date of death as the floor. So if there is a tax on the capital gain, it's only going to be on the difference between the date of death value and the net proceeds of sale, which is going to be obviously a much smaller amount. So it can be critically important. There are ways to make the transfer and keep the basis. It's a great question, and it's one, if you're dealing with this issue, make sure you raise and are comfortable with the answer. For example, the law doesn't require that the transfer be just outright. Mom is the sole owner, now you are the sole owner as the child. One would mean a loan of transfer that works, particularly if you're confident that you're not going to have to sell the house during the parent's lifetime, is a sale involving a life estate. This gets technical fast, but the idea is that mom is still holding on to the right to live in the house. That's going to be on the deed. But the deed itself says that on mom's death, the child is going to be the sole owner. Technically, it's a transfer, a deed of a remainder interest with a reserved life estate. That's the technical format for this. In that situation, the step-up in basis applies. Also, mom's interest in the house disappears at her death. There's no estate recovery. There's no concern about the estate getting the house after her death under current law. So it is a way that you can do both. You can avoid a claim against the estate of the mom and also get the step-up in basis, so that when you do sell the house, there'll be a huge advantage.
I see. Thanks, Don. I think at this point, we're going to turn the evening over to Tracy Schneider now, who is the coordinator for this evening.
Welcome,
Tracy?
everyone. I'm so sorry that I wasn't on at the beginning of the call. We had a little bit of a glitch with the Zoom link, and I was quickly emailing everybody to get that corrected. And we will have a new flyer, and everything will be corrected for the next program. I don't know if you each gave background about yourselves when you started.
No, we introduced ourselves. That was it. There's stuff on the brochure. We don't.
Okay. Okay. All right. So I wanted just to publicly acknowledge Benchmark. Benchmark at Evans Park is sponsoring this series, and Megan Romeo is on the Zoom call, and I wanted to introduce her. I'm very excited to work with Megan. We've been talking about going forward with different programs for next season, and in the past, Benchmark sponsored our Thanksgiving lunch. If some of you came last season to our wonderful Thanksgiving lunch that we had, and Benchmark was supposed to sponsor our fashion show last spring, but it got canceled because of the pandemic. So I'm thrilled to work with collaboratively with Megan. And when I brought up the idea of elder law and spoke with Dawn and Audrey, we were all on board. It was just, we're very excited to have this program. So I want to turn it over to Megan for just a few minutes to introduce her and to welcome her. Thank you.
Thank you so much, Tracy, Audrey, and Dawn. This was amazing. I took so many notes for myself, for me to share with my family. I know my grandparents are looking at Medicare Part C plans, and now I know that they are not a good idea and how they can maybe even, limit some of their choices. So thank you so much, Audrey and Dawn, for all of your expertise. I'm very excited to be a part of this wonderful program with Tracy and Temple Emmanuel. I work at Evans Park at Newton Corner. I'm sure some of you are familiar with our community, but for those who are not, we are a community that specializes in independent assisted living and memory care. And we also have 5 sister communities within the Newton and Waltham area. I'd be happy to put my contact information in the chat. So if there's anyone that has questions about the community or available services, don't hesitate to let me know.
Thank you so much. Thank you so much. And again, we are meeting, this is only the first of our 5-part series. And we are, our next session will be on November 17th. It's called I Was So Careful, but Now I'm COVID Positive, which I almost had a scare in my family, my husband. So I know the fear with this one. What should I have done to be ready for this? And Audrey and Dawn so graciously will continue in the series. And I think we have more time. Do we have more time? Do you want to stay on for a few more minutes for questions? Or I know we were supposed to wrap up at 7:30. Dawn and Audrey, do you
I don't know, were there more questions in the chat?
Actually, there's one, just if I can make one last point about the whole Medicaid planning thing.
Sure.
I'm not sure I have what I wanted to say, but I think I remember what I had in mind. I've made some snide remarks about things on the radio and so forth. I think this whole idea of sort of targeting planning toward establishing Medicaid eligibility can in certain cases be useful. For many people, it's absolutely essential and a life-saving tool. There are many risks and downsides to it, and I think people just have to be very careful if they start engaging that. The first problem is it's a tail wagging the dog situation where the question the client asked me is, how do I get eligible for Medicaid? Thinking that's going to be the cure-all for his situation, not knowing what his future is going to bring, not knowing what the program is going to provide in the future or what he's going to need. Also, the control issue is critical. I mean, the Medicaid planning almost inevitably involves transfers of assets, giving up access and control to at least part of what you have. And people might be confident based on their current array of needs and resources and things that are getting earned that they're okay with that, of giving up some of this. But I think they just need to be very, very cautious about giving up control. Just don't know what the future is going to bring. And in situations where assets aren't so limited that they're going to be exhausted unless you do something, I think just Medicaid planning has to be undertaken with great caution.
Sure.
Yeah.
Dawn, I'm not sure, I might have missed this. Did you mention veterans benefits?
Oh, all right. It's actually in the materials. I didn't get to it. I think it was something went out by email tonight, I think, that had.
I sent it out, but I haven't read it yet because.
Okay. All right. So, there were several things on there that I decided I would just leave to that. There's an important veterans program called Aid and Attendance. There's also another one called Homebound Services. That's its own universe in terms of eligibility and so forth. It can be quite effective. It can be used in the assisted living context with qualified beneficiaries. I don't have the numbers in front of me, but it's it can be another $1,800 or something like $1,600 or something like that, and extra resources available for assistance.
Just personally, from my own, my father was a veteran of World War II. He passed last year. He was 93.
Yeah. No, it's a program. It's cumbersome to access. It relies really on veterans associations and volunteers, partly because nobody can bill professionally to help a veteran get into a veterans program. So I understand that's a nice idea, But the problem is that there's just a limited number of people who are in a position or in agencies that can pay them to do that kind of counseling.
The other issue with veterans is that you do have to make sure that you are satisfied with the health care that they're administering, you know, and that can be somewhat inconsistent from state to state, and availability of it can be inconsistent state to state. So
let me just clarify this on the aid and assistance. There are several different VA programs that relate to elders. Some involve the use of the VA hospitals.
Right.
We lost it now, but we had what was considered an excellent Alzheimer's facility here in Massachusetts that's now closed. That was a veterans facility, and with a lot of effort, a lot of long waiting lists to get veterans in there because it was such a good program. Veterans can also provide support for nursing home placements. The VA operates some but few nursing homes on its own. It's mostly a cash support program. Aid and attendance is completely cash support. Yeah. They don't really provide services themselves. They just give you money.
And Don, that used to be pretty, their requirements, their assets and their income used to be fairly workable. They were reasonable. And I've used aid and attendance a lot in assisted living, using that for help fund assisted living for people.
Yeah, you don't have to be. They're not. They work best in situations where there's there's just one spouse left. The veteran is alone, has income limited to Social Security and maybe a VA pension, but has limited income. It works very well in those situations. But there's also an asset limitation, which is a little flexible. It's a little hard to get a gauge on. They kind of work it into some sense of your
kind of formula. Yeah,
it's a formula that's not easily applied. But it's a number of people get into it. It can be very useful.
And again, I think it varies state by state in terms of what's available when you go for veterans.
The services, but again, not for the cash support.
Exactly, for the services, yeah.
Audrey, I got a private question to me that I think would be better directed to you. And this was, could you please explain what a care manager does, how much they typically cost, and if they are covered by any insurance benefits?
Sure. So we as care managers are elder care consultants. We are typically licensed professionals, either social workers or nurses, who work on a private fee-for-service consulting and counseling elders and their families on healthcare issues, housing issues, supportive services for seniors in a certain geographic location. So it's really my job to know not just the names of the nursing homes, but to know the directors of nursing in those nursing homes, to know what level of care they're providing. We act as consultants. We are a private fee-for-service, although many long-term care insurance policies will pay for us. And we bill out at an hourly rate, just the way any attorney would, or any social worker would in private practice. That answers.
I'm just looking on the list. I think we've at least touched on it.
And I think Megan showed us, Megan is actually hosting at Evans Park on November 5th at 2, an event regarding veterans benefits for those who might be interested. It really is a specialty, isn't it, Don?
The little I know about it, it is.
I'm sorry, I didn't mean to interrupt. Go ahead.
Oh, I'm so sorry, Don. I was just saying it is a specialty. This discussion it's with an organization of volunteers that actually helps to explain what benefits are available to veterans, their family members, what the eligibility requirements are, and how to apply. They even help you through the application process. And there's even a couple of cool door prizes available from the volunteers. So if there's anybody that's interested, please don't hesitate to reach out. And I'll turn it over to Don.
I would like to, if I can do the scheduling, I'd love to. Is it going to be?
Oh, that would be great.
To attend, yeah.
Yeah, I'm really looking forward to it. They even explain how you can get funds each month and it can help pay for home care, equipment. So
This program, it's probably 8 in attendance.
Yeah, it sounds like it would be a great program. And of course it's hard to learn about it. So it would be great to, see some familiar faces from tonight's event.
If I can interject, my father did not get 8 in attendance because you have to have a minimum, I guess there's like a minimum, right? Minimum of income. So he did not qualify for that. However, because he was a World War II veteran, and I met with the Office of Veteran Affairs in Newton City Hall, I was able to fill out it was a lot of paperwork. The paperwork, and I'm thrilled to hear that there are volunteers to help with that paperwork, because it really is, you need a lawyer to sift through the paperwork. But I was able to actually, the last year of his life, increase the benefits that for some reason he never got. It was like a 10% connected, and I was able to get him, I don't know, 70% connected, something like that. And so the last year of my father's life, I was able to use that money to pay for both my parents' the rent in their apartment, because they had sold their house. So it was a lot.
That's great.
Work, but it was worth it. And I just, more than the money, I just felt good about, doing this on his behalf, because he couldn't do it for himself.
Yeah.
And don't be, and even if you don't qualify for that minimum amount, even if you have more in income or in assets, you can still get benefits from the veterans. So I just want to put that out there. Anyway, I think we have to wrap up. We're way past the 7:30 mark, but I'm thrilled that this went this long. Dawn, thank you so much for your time and your expertise, and Audrey as well for your time and for your expertise. This was fantastic.
My pleasure.
And I apologize for any glitches on the flyer. We are going to fix that and have the team at Temple Emmanuel fix the flyer and all the Zoom links. Our next meeting is, again, is November 17th at 6:15. And if Dawn or Audrey I sent something out tonight, the paper that you asked me to send, but if there's anything else, I will be communicating with people, and that's why I took everyone's email. And just quickly, because I wasn't able to say anything in the beginning, I just am grateful to Temple Emmanuel and our executive director, Jeff Lurie, for understanding that there's a need in our community for an array of social and educational programs for our longest standing members of Temple Emmanuel and the greater community. Temple Emmanuel offers adapted seated exercise, Zumba Gold, L'chaim music and entertainment, memory cafe, two caregiver support groups, an adult support group, artful afternoons, and a healthy living series. And that's just this year when we don't meet in person. And when we come back and meet in person, we will return to our lunches, longer programming, and fashion shows and Thanksgiving lunches and all the fun things that we did before we were relegated to Zoom. So again, thank you so much for Dawn and for Audrey. They put in a lot of time preparing for this. They worked all summer on developing this program, and I really, really appreciate it so much. Thank you everyone for attending. If anyone has any questions, this program is going to be recorded, and we will get the link at some point in the future. So I know some people have already chatted that they missed part of it, and I will be able to send that link out so that you can play it over again and get more information. And thank you everyone. And again,
Thank you.
Thank you.
Everybody, thank you so much.
Good night, everyone.